Welcome to the deep dive. Today, we are locking onto a systematic, completely objective approach to markets known as trend following.
Right.
This is not about listening to financial news or guessing the next market cycle or, seeking out stock tips.
Yo.
It is a cold, hard, disciplined philosophy that has minted fortunes across every market environment you can imagine. Bull runs, decades-long bear markets, and those notorious Black Swan events.
And if you, the listener, have ever watched successful speculators operate with this almost chilling detachment, generating just spectacular wealth by ignoring every conventional piece of financial wisdom.
The pundits, the headline.
All of it, and most importantly, ignoring their own innate human emotions.
Okay.
Then this deep dive is really your definitive shortcut to understanding their methodology.
Our mission today is to move far beyond just the surface definitions. We're going to unpack the fundamental principles of this philosophy, dive into the mechanics of why it actually persists, and then study the lives and the enduring strategies of its greatest practitioners.
Yeah.
What we are really examining is the core identity of trend following. It's an objective, mechanical, price-based method where risk management isn't an afterthought or some emergency button.
No, it's absolutely baked into the initial recipe. It's there from the start.
The promise we're delivering today is clarity and a structured perspective.
Trend following is a methodical, systematic process, and its strategies are universally applicable across every single asset class: stocks, commodities, currencies, bonds, energy, metals, you name it.
And that universality provides a quantifiable competitive edge over those who are, constantly paralyzed by analyzing endless streams of information and ultimately paralyzed by their own fear and greed.
Exactly.
Let's start with the name itself, trend following. It sounds so obvious that I think a lot of people just dismiss it, but that simplicity masks a deep, really demanding discipline. Let's break down the two components, starting with the trend.
Okay, so at its most basic level, every single trader, investor, speculator, they need a trend to make money. It's that simple.
Right. If it doesn't move, you can't profit.
You can't. If you initiate a position, whether you buy, go long or you sell short, and the market price just stagnates or drifts sideways after that point, you cannot generate a profit. You need volatility and you need directional movement.
No matter how good your analysis is.
Doesn't matter. No matter how sophisticated your analysis, if there isn't a sustained trend in motion after you take a position, profit generation is, it's mathematically impossible.
Okay, and then the second part, following. This is where the ego check really happens.
It is. Trend followers are fundamentally non-predictive. They do not claim to know where the market is headed next month or next year.
They're not gurus.
Not at all. They wait for the market to actually establish a directional movement for a trend to shift, and then they follow it with their capital. They are reactors to confirmed motion, not, seers trying to anticipate the future.
And that approach, that leads directly to the crucial mechanical rule that really defines the entire strategy, right? Cut losses and let profits run.
That's the one. A successful trend-following method must automatically limit the loss on any single position, long or short, without placing any artificial limit on the potential gain.
The loss has to be capped, but the gain must be uncapped.
Precisely.
But how does that work in practice? It sounds like simple common sense, but, common sense is notoriously uncommon when it comes to trading. What are the practical mechanics of that automatic loss limit?
Well, the mechanism is a predefined exit point, a stop loss, that is set at the same time as the entry.
Simultaneously.
Right. When a trend, once it's established, reverses quickly or stagnates, there's always a point, and it's typically defined mathematically by a trailing stop or a price break outside a specified channel. There's a point where the evidence of the original trend dissolving or a new trend forming in the opposite direction, it becomes clear.
And that's the trigger.
That is the mechanical exit. For example, if a price breaks below the lowest low of the last 20 days, the system just exits, period, regardless of the news or the story. This removes that subjective decision-making that leads people to hold on to losers just out of hope.
It's fascinating that despite this straightforward, almost brutal logic, wait for movement, get in, define the maximum loss, and let the upside be unlimited, the strategy remains so widely misunderstood. It's often dismissed by conventional investors. Why does something so robustly proven kind of hide in plain sight?
I think it hides because it requires you to be wrong frequently. A lot. Trend followers typically have a win rate far below 50%, sometimes as low as 30 or 40%. The human ego, it cannot easily accept being wrong that often.
That's a tough pill to swallow.
It is. Yet the systematic strategy has remained effective for over a century precisely because it exploits inherent stable human behaviors, like anchoring and herding, which create the persistent market trends that, well, they just never change.
Let's address the language we're using here. Speculation is often treated as a dirty word in finance. It's seen as synonymous with reckless gambling, or, as some of our sources have put it, the mother of all evil.
Right.
But the pioneers we are studying, stretching back centuries, they viewed intelligent speculation as an honorable act.
And that reframing is absolutely essential. Intelligent speculation is fundamentally different from gambling because it's the professional application of shrewdness and calculated risk against the inherent uncertainties of the future.
It's a business.
It is. And the source material reminds us that, in a profound sense, life itself is a speculation. When you take a new job or buy a house, you're speculating on future conditions, that you'll remain healthy, employed, and that the economy will cooperate.
That makes a lot of sense. But how do we draw the line between the professional speculator and the haphazard gambler, especially when the statistics of failure are so bleak?
That's the critical distinction. You are pitting the professional against the haphazard man. Take David Ricardo, arguably the first trend player ever known. He was active on the London Stock Board between 1772 and 1823.
Wow, that far back.
Oh, yeah. He made speculation a structured, methodical study and a genuine business. He adjusted his machinery, his rules, and his mental framework to every detail.
But if 95% of those who speculate fail, doesn't that inherently make it closer to a high-stakes gambling strategy?
That's a fair challenge.
Yeah.
But the source material clarifies the data. While the proportion of failure in speculation is indeed about 95%, the key insight is that this failure rate is not greater than the proportion of failure in general mercantile life.
Like startups, small businesses.
Exactly, or any other risky venture. The difference lies only in the speed and the visibility of the failure. Speculation yields quicker, more startling action. The haphazard person relies on luck, operates until their luck runs out, and invariably drops their money.
And the professional.
The professional finds out very quickly if their system is fundamentally flawed, which allows for much faster adaptation or, elimination.
So the professional speculator is simply someone who approaches market uncertainty with a rigorous, systematic business plan. They accept the risk of failure, but they work to limit its magnitude.
Precisely. They treat it as a business that requires continuous study, calculation, and strict adherence to rules, not some thrill-seeking avocation. And the difference between that 95% who fail and the 5% who succeed, it really just boils down to psychology, how they process failure and profit.
Okay, let's examine the loser's mindset. Based on our sources, those who consistently lose in the market, they often rationalize winning as purely dumb luck when it happens to somebody else.
Right, he just got lucky.
Exactly. And they seek constant excitement. They need investing gurus, hot stock tips, market gossip for entertainment. And crucially, they boast about their portfolios because their ego requires that external validation.
And when they lose, they get angry, they get depressed, and they double down, chasing the thrill of recovery.
The winner's mindset, by contrast, is defined by relentless discipline, intellectual integrity, and the willingness to accept drawdowns as just the cost of doing business.
They understand that profit-seeking is the absolute, unromantic driving force of markets. They are systematic, and they are not embarrassed about wanting the money.
Speaking of winners and losers, that brings up an uncomfortable reality that few retail investors ever want to face. The market, in this context, is a zero-sum game.
It is absolute. Every single profit made by a trend follower comes directly from the loss incurred by another market participant. John W. Henry, one of the most successful speculators we'll analyze later, he was crystal clear on this.
What did he say?
He stated that his profits come from relying on the fundamental fact that other investors are convinced they can predict the future. Their misplaced conviction leads them to hold losing positions too long or exit winners too early, and the systematic trend follower simply captures that loss.
But how do they mechanically capture that loss?
By being objective. If a major trend is underway, say the price of copper is accelerating upward, the crowd is always hesitant. Fundamentalists debate whether the move is justified. Amateurs fear buying at a high price.
But the trend follower?
The systematic trend follower, devoid of any opinion, simply detects the acceleration and initiates a long position, often adding to it as it continues. They stay in until the trend turns.
So they're capturing the profit from those who were wrong.
Yes, those who resisted the trend or shorted it based on valuation, they're forced to liquidate at a loss, providing the fuel and the profits for the trend player. It's an exercise in exploiting human hesitancy and predictive hubris.
This objective approach, it mandates a definitive shift in identity. There's a crucial distinction that separates the successful trend follower from the typical market participant. The difference between an investor and a trader.
A huge difference. The investor buys into fundamental stories, often, very rosy projections about growth, innovation, or long-term value.
They fall in love with the story.
They do. And they typically ride bubbles straight up because their guiding philosophy is hold on forever. They lack a defined exit plan, making them extremely vulnerable to cognitive biases like anchoring and confirmation bias.
The classic example being Enron. People weren't just shareholders, they were believers in the story.
Exactly. Owners of Enron stock never stopped seeing the pot of gold. They suspended disbelief, convinced the fundamentals were sound, or that their long-term conviction would somehow save them. They had no strategy or process to sell when the price trend turned violently against them. Their identity was tied to the asset's success.
The trader, on the other hand, operates with a defined strategy to put capital to work for profit. Period.
That's it. They're completely agnostic about the underlying asset story. They don't care if they're buying copper, selling the yen, or trading bonds. They only care that they follow their rule set and end up with more money than they started with.
So they're not investing in anything in the traditional sense?
No, they are treating momentum. This distinction entirely centers on the primacy of process over belief.
When you adopt that trader identity, you eliminate the emotional weight of being wrong about a company you admired.
You have to. The trend follower views the market as a laboratory for testing systems, not a place to express personal opinions about value. This psychological separation is it's foundational to systematic success.
And this philosophical separation leads us directly to the trend follower's famous dismissal of fundamental analysis, the deep dive into earnings reports, PE ratios, GDP forecasts, which they often refer to as fundamentals.
Fundamentals, yeah.
Why such harsh skepticism?
Because fundamentals are functionally incomplete. They are brilliant at giving you a compelling reason to get in and a captivating story about future growth, but they are utterly silent on two critical things: rules for how much to buy, and more importantly, rules for when to get out when the story inevitably turns sour.
They trap you.
They trap you. The legendary anecdote from Ed Seykota perfectly illustrates this paralysis.
Right, the story with the knife.
Exactly. Seykota was having dinner with a fundamentalist who was deep into a complex analysis of a stock's valuation. Seykota accidentally knocked a sharp knife off the table, and it landed with the pointed end sticking right into the fundamentalist's shoe.
And the guy just sat there.
He didn't move. Seykota waited, watching his reaction. Nothing. Seykota asked why he didn't react, and the fundamentalist remained paralyzed, unable to shift from his intellectual analysis to immediate necessary physical action. It's the perfect metaphor. Fundamentalists analyze the danger. Trend followers simply react to the price change, regardless of the cause.
In stark contrast, trend followers rely on technical analysis, which they accurately define as pure price analysis.
Yes, and the core thesis is that at any given time, the market price reflects the dollar-weighted collective opinion of all participants. It's the ultimate consensus on all known factors affecting supply and demand.
The price is the only truth that matters.
It is. If the price is moving up, it means the aggregate buying pressure is currently stronger than the aggregate selling pressure, regardless of what the CEO said last quarter. Trend followers use technical tools, often simple ones like channel breakouts.
Like Donchian channels.
Right, which track historical highs and lows, or long-term moving averages, simply to detect when that collective opinion has shifted decisively enough to warrant taking action.
But critics often dismiss technical analysis as, astrology or reading tea leaves. How does the systematic approach overcome that skepticism?
Because it avoids trying to outthink the market. The technical approach never guarantees entry at the exact bottom or exit at the exact top. That's a fool's errand.
Sure.
Instead, the systematic trend-following advantage is patience and objectivity. It waits for confirmed conditions, the trend, rather than forcing non-existent opportunities. If the market is choppy or directionless, the system generates no signal, and the trader just sits on their hands, saving their capital and their energy for when genuine trends finally appear.
This brings us to the ultimate firewall, the thing that protects the trend follower from emotional self-destruction. The reliance on absolutely systematic rules over discretionary gut trading.
Yes. Discretionary traders rely on subjective judgment, their gut, sifting through a never-ending stream of data and thinking their personal insight can consistently outwit the market consensus.
And that leads to decisions colored by personal bias, fatigue, continuous second-guessing.
Absolutely. They break rules they made yesterday based on how they feel today. The source material is unequivocal here, stating that a multi-decade track record produced by gut trading is 100% fantasy. It simply doesn't happen consistently over time.
So the power lies in adopting mechanical rules. How specific are these rules, and how does that rigidity actually create freedom?
The rules are absolute. They have to be convertible into computer code. They define the entry criteria. For example, price crosses above its 100-day moving average, the position size, which is how much to buy, and the exit criteria, the stop-loss mechanism.
And this eliminates that emotional vacillation.
It eliminates the I would be, could be, should be paralysis. And it forces the discipline that's necessary for longevity. The rigidity creates freedom because it removes the cognitive burden of decision-making during moments of high stress.
But doesn't using only mechanical rules remove the possibility of exercising good judgment when, say, the Fed announces a sudden policy change that fundamentally alters the landscape?
That's the classic discretionary temptation. The problem is that the moment you use your discretion to overrule the mechanical system, say moving a stop loss because you feel the market must rebound, you're guaranteed to go broke over the long term.
Guaranteed.
Guaranteed. The system is designed to handle those random events by simply reacting to price. If the Fed news causes the price to hit the mechanical stop, the system exits. It avoids further damage. Longevity in this business is measured by unbending discipline to the process, not by moments of perceived genius.
The skeptics always claim that the structure of markets has changed. Algorithmic trading, high-frequency trading, globalization, meaning that the trend-following strategy must be obsolete by now.
Right. This time it's different.
Yet, the trend followers' worldview sees market history as cyclical and human nature as a constant.
And that is the cornerstone of their belief. The philosophical foundation of trend following has not changed, and it will not change. Markets behave the same today as they did centuries ago because human behavior in aggregate remains fixed.
The belief that this time it's different is one of the most expensive errors any speculator can make.
Absolutely.
So why do trends continue to exist if markets are supposedly so efficient?
Trends are driven by uncertainty, and uncertainty is perpetual. Large directional shifts result over months or even years as investor expectations are gradually adjusted to new realities. The drivers include persistent behavioral biases like herding, market frictions, large institutional hedging demands, and continuous interventions by central banks.
As long as people are prone to irrationality.
And slow to adjust their expectations, trends will be available for followers to capture.
Patrick Welton actually tested this skepticism empirically, didn't he?
He did. He constructed over 120 different trend-following models, including many advanced ones, and he found absolutely no statistical evidence that the strategy has devolved or become less effective over time.
So it's still robust.
If anything, market interventions and volatility spikes provide excellent conditions for the strategy to thrive. The reason it works is simple. People are psychologically wired to be poor decision makers, and trend following acts as an arbitrage against that human frailty.
This psychological framework, it ties directly into the risk management structure, specifically through what Charles Faulkner called the option analogy.
Right. The trend following essentially operates like holding a long option.
Explain that.
Correct. When you buy a long option, the cost you pay is finite. That is your maximum possible loss. But the potential gain, if the underlying asset moves sharply in your favor, is, well, theoretically unlimited.
And the stop loss is the cost of the option.
Exactly. The systematic stop loss in trend following automatically caps the downside, which is the cost or the premium of the option. The continuation of the trend creates the large, virtually unlimited upside.
But if, as you mentioned earlier, trend followers are often wrong 60% or 70% of the time, that means they're paying that premium very frequently. How does the model mathematically justify enduring that string of frequent small losers?
It's a non-negotiable cost. Those limited losses are the option premium that must be paid to ensure the trader is always positioned to participate in the rare, massive moves, the market dislocations or prolonged manias that define their success.
So you have to understand the arithmetic.
You do. You may have 65 trades that lose 1% of your capital each, totaling 65% in small losses. But if you capture just 3 trends that deliver 25% profit each, your overall system is enormously profitable.
That requires incredible psychological fortitude, though. It means you must be comfortable accumulating pain for months, maybe even years, waiting for that massive payout.
Exactly. And this is why the winner must allow their winners to grow large. They cannot risk leaving profits on the table. The source material highlights the wrong thinking of a novice trader.
Right, the one who banks the profit too early.
Yes, the one who starts with $50,000, sees their account grow to $80,000, and immediately pulls out the $30,000 profit to bank it.
Why is that considered disastrous? I mean, on the surface, that sounds pretty prudent.
It is disastrous because that $30,000 profit might be the beginning of a move that balloons into a $200,000 profit, which is necessary to cover the hundreds of small premiums paid over the years. By pulling the profit, you prematurely cap the option's upside and you destroy the fundamental payoff structure.
So it requires patience to sit through the volatility and keep the trade on until the reason for the position no longer exists.
Right, not until you feel rich enough. The system tells you when to get out, not your feelings.
Now we shift from the philosophical and the mechanical to the human element. The careers of the pioneers who successfully applied these demanding, systematic principles provide really the undeniable proof of concept.
That objective discipline, applied systematically, wins over subjective emotion. These individuals didn't just have systems. They had worldviews that allowed them to execute those systems with integrity. Their adherence to process is what ultimately sets them apart.
Let's start with David Harding, the founder of Winton Capital. He represents the highly mathematical, modern evolution of this philosophy. His approach, detailed in the Winton Papers, is purely scientific.
Harding completely divorced himself from the traditional macroeconomic opinions that cripple most discretionary traders. His focus is exclusively on mathematical phenomena and statistical distribution.
So he's not debating Fed policy?
No, he's studying how the market reacts to uncertainty and change, using rigorous statistical methods to model those reactions.
What's fascinating is his deep understanding of behavioral economics. He doesn't believe markets are efficient, but he does believe human behavior is systematic.
That's his core edge. Harding observes that the aggregate effect of shared mental biases, the herd mentality, the disposition effect.
Selling winners too early, holding losers too long.
Exactly. And anchoring, sticking to an old price, all of this results in demonstrably systematic behavioral patterns in the market. Winton's algorithms are designed specifically to exploit the predictability of human irrationality. They are betting that the average investor will continue to react the same way to fear and greed today as they did 100 years ago.
If the Winton model is designed to maximize gains during volatility, the conventional assumption would be that it carries significantly higher risk than traditional investing. How did Harding counter that?
He challenged the very definition of risk itself, specifically through the drawdown measure. Harding pointed out that the historical maximum drawdown for a globally diversified trend-following portfolio is typically only 75% of the magnitude of the maximum drawdown experienced by a traditional 60-40 buy-and-hold stock and bond portfolio.
So in other words, over the long term, trend following has offered better risk-adjusted returns and less severe worst-case scenarios than passive investing.
That's what the data shows.
Let's talk about Bill Dunn, Dunn Capital Management. Another foundational figure, a true systematic pioneer whose longevity really speaks volumes.
It does. He began by developing his own commodity trading system after realizing the power of mechanical rules.
And his system, using daily data, was incredibly strict. It looked for clear, big trends, defined by price movement outside recent extremes, and it automatically reversed positions if the trend shifted decisively. Importantly, Dunn's trades are long-term. What does that mean in practical terms?
It means positions are often held for well over a year. Trend following is not day trading. It is about capturing massive, sustained moves.
Yeah.
If you try to exit every few weeks, you kill that option payoff analogy we discussed. Dunn's resilience is rooted in the long time horizon of his system.
His risk management, however, is highly technical and precise. He uses something called volatility titration to size positions. Can you elaborate on that?
It's a core innovation. Instead of risking a fixed percentage of capital on every trade, regardless of the market, Dunn Capital adjusts the position size based on the market's inherent volatility. This is often measured using the average true range, or ATR.
So the more volatile a market is.
The smaller the position size they take. This maintains a standardized level of risk exposure across their entire portfolio. Conversely, a less volatile market allows for a larger position. This process ensures that the maximum acceptable risk constraint is maintained across all assets, and it forces discipline.
And this disciplined approach allowed them to endure massive drawdowns, but also achieve some phenomenal recoveries.
Yes, his composite record is remarkable for its resilience. They suffered a crushing 52% drawdown in 1976, and another 40% loss during the 1999-2000 tech bubble peak, which was devastating for many. But because they adhered to the systematic process, they recovered that entire 40% loss in just 3 months, allowing them to participate fully in the subsequent bear market trends.
So their clients have to be psychologically prepared to endure and really ignore those necessary painful periods.
They have to be. And unlike traditional buy and hold investors, Dunn Capital remains absolutely directionally unbiased. They go short just as often as they go long. When the dot-com bubble burst or when a commodity price collapsed, their systems automatically went short, turning devastating market conditions for others into massive profit opportunities for themselves.
Next up, John W. Henry. He scaled his systematic trading operation into an empire large enough to purchase the Boston Red Sox. He built his success upon what he calls his 4 pillars.
Those pillars are essential for longevity: long-term trend identification, a highly disciplined investment process, risk management, and global diversification. Henry focused on simple, powerful heuristics, mathematical and statistical rules applied consistently across dozens of markets.
Let's revisit his crucial insight on the zero-sum game, which he used as a philosophical driver.
Henry explicitly relied on the fact that other investors were convinced they could predict the future. This conviction leads to overconfidence, emotional entries, and failures to cut losses, making them the consistent losers whose capital Henry's system harvested. He understood that his profit source was the inherent behavioral flaws of the typical market participant.
His emphasis on longevity and discipline is a powerful warning against micromanagement. He stated that models he developed 20 years ago were still in place today.
That's a testament to the stability of human behavior. Henry also found that using extremely close stops just to avoid volatility actually inhibits the system's ability to stay with the long-term major moves. You incur tremendous opportunity costs over decades.
So if you try to make your returns look too smooth,
You ultimately destroy your potential for outsized, trend-driven profit. Longevity is not measured by performance over 1 year. It is measured by the discipline to stick to the system over 20 years, enduring all of the necessary drawdowns.
And the ultimate confirmation of his systematic thinking came when he applied this non-emotional, data-driven approach to baseball.
Yes. When he bought the Red Sox, he applied the same mathematical principles, simple heuristics, statistical analysis, and data-driven decision-making to player recruitment and game strategy, famously emphasizing objectivity over traditional gut-feeling scouting. It demonstrated that systematic success isn't just a financial principle, but a general principle of data-driven execution.
Now for Ed Seykota, the computerized pioneer.
Ed Seykota, who earned his Bachelor of Science from MIT in 1969, is one of the true foundational figures, especially concerning the technical application of these rules.
His key contribution was conceiving and developing the very first commercial computerized trading system for client money in the futures markets. That was back in 1972.
Right. Before that, trend following, while it was practiced, was often manual or semi-manual. Seykota paved the way for the sophisticated systematic hedge funds we see today.
But while he was a technical innovator, Seykota's lasting contribution may be in trading psychology and the brutal honesty of self-knowledge.
I agree. He focuses intensely on exposing people's psychological weaknesses, believing that the external market is only a reflection of internal issues.
He had that remarkably insightful observation that some people actually win by losing money. What did he mean by that counterintuitive idea?
It refers to the deep-seated psychological need to fulfill a narrative or to be right intellectually, even if it costs you capital. For some traders, the satisfaction comes from correctly predicting that a stock is overvalued, and they hold their short position as it rallies, saying, "See, I knew it was going to crash eventually."
They win the intellectual battle but lose the capital war.
Exactly. Seykota observed that these individuals sabotage their own systematic success because they are unconsciously driven by the excitement of conflict or the confirmation of their own analytical genius, rather than pure profit.
And his crucial reality check is something all systematic traders must confront.
Absolutely. He cautioned that no amount of math, data, or technical analysis can eliminate the fundamental reality of market uncertainty. He said, "Markets are fundamentally volatile. No way around it. Your problem is not in the math. There is no math to get you out of having to experience uncertainty."
So traders must live with and feel that uncertainty.
Yes, which requires intense self-management and adherence to the mechanical rules when the anxiety is highest.
Let's talk about Richard Dennis and the turtle experiment.
Richard Dennis, a legendary trader who made a fortune in Chicago, is best known for that famous turtle experiment, which demonstrated his revolutionary conclusion. Trading was even more teachable than I imagine.
So Dennis bet his partner that he could teach a group of novices with diverse backgrounds to trade successfully using a rigid, systematic method.
And he proved it. The experiment showed that trading success wasn't some innate talent, but a disciplined, learnable skill based on adherence to rules.
His strategy emphasized holding power, that patience necessary to maximize the option payoff.
Yes, his mandate to the turtles was stern. When you have a position, you put it on for a reason, and you've got to keep it until the reason no longer exists. Don't take profits just for the sake of taking profits.
He focused strictly on the mechanics of buying and selling.
Because, as he often said, you don't get any profits from fundamental analysis. You get profit from buying and selling.
The turtle experiment demonstrated the power of the system, but it also revealed the power of psychology, because not all of the turtles sustained their success after leaving his tutelage.
That's the critical postscript. Many failed because once they were unsupervised, they started introducing discretion, breaking the rules, or letting fear guide their exits during the inevitable drawdowns.
But there was an exception.
Jerry Parker is the monster exception. Parker, the most successful of the turtles, successfully ran Chesapeake Capital Management for decades by simply maintaining the absolute discipline taught during the experiment. His success proves that the system works, but only if the individual maintains the psychological fortitude to stick with it through the pain.
The principles we've discussed, they're not new inventions of the computer age. They have a rich, continuous historical lineage.
A lineage that shows human nature, and therefore market dynamics, never really changes.
In the mid-20th century, we have Richard Donkian, often called the father of trend concepts.
Right. Operating before widespread computer use, he pioneered weekly rules for identifying and acting on trends. His focus on channel breakouts, for example, buying if the price closes above the highest high of the previous 4 weeks, was purely objective.
And stepping back further, the influential speculator Jesse Livermore, active in the early 1900s, focused almost entirely on price movements.
He didn't care about a stock's intrinsic value. He cared about volume and velocity. After 40 years of trading, his fundamental observation remains brutally relevant. Wall Street never changes, because human nature never changes. The markets, the pockets, the stocks, they all change. But the core psychological drivers of fear and greed are constant.
Livermore provided the anecdotal proof, but Dixon Watts in the 19th century provided the foundational psychological requirement for systematic success. He listed 5 mandatory qualities for speculation.
And these qualities beautifully summarize the necessary mindset. They are observation, seeing what is happening, not what you think should happen, memory of past market reactions, calculation for position sizing and risk, promptness. The mind is convinced, the act must follow immediately, and pliability, the ability to change an opinion instantly when the price dictates it.
Watts warned that a deficiency in one destroys the effectiveness of the others.
A careful balance. And finally, the historical line traces all the way back to David Ricardo in the late 18th century, the methodical speculator who used calculated risk and careful study, arguably the very first documented trend following trader influencing and inspiring all the later masters.
What should stand out most clearly in this deep dive is the relentless, almost religious focus on the systematic process and cold, hard discipline completely divorced from prediction.
Absolutely. Whether you look at David Harding's advanced mathematical algorithms or John W. Henry's simple heuristics, the mantra is objective, disciplined, and systematic.
And the performance data validates this choice over conventional wisdom, not just in theory, but in catastrophic market periods. For instance, during the brutal bear market of 2002, when passive investors were bleeding capital, Bill Dunn's system returned plus 54.23%.
And John W. Henry returned plus 45.06%. This strategy works consistently because it captures market fear. It doesn't try to avoid it.
The most successful systematic traders view their frequent small losses as the necessary option premium, the cost of doing business.
It's a cost they must pay in order to be perfectly positioned for the immense rare trends that generate those spectacular returns. They have separated themselves from the emotional feedback loop entirely.
Which leaves you, the learner, with the final provocative thought that the source material compels us to consider. If you take the robust multi-centennial performance data of systematic trend following seriously, you face a pretty unambiguous choice.
You can accept the data as fact, make an honest assessment of your current emotional or discretionary approach, and commit to systematic change.
Or you can pretend the performance doesn't exist and stay on passive indexing autopilot while waiting for the inevitable correction.
The choice is one of process versus hope. The data is the truth. Everything else in the market is just white noise distracting you from the disciplined action required for success.
Welcome back to the deep dive. You know, when we talk about finance, we usually end up talking about beating a benchmark, right? Or which stock market index had the best quarter.
It's always about relative performance.
Exactly. Well, today, we're completely throwing that framework out the window. We're scrapping in for a pretty high-octane exploration of what real financial performance looks like. We're focusing not on relative success, but on absolute survival and absolute profit, especially when the financial world is, well, actively collapsing around you.
Yeah, our mission here is to really unpack the metrics that define success in a systematic way. We're talking about risk, we're talking about drawdowns and, just proving performance. But we're not just going to stop with the theory.
No, not at all.
We're going to immediately apply all that knowledge to some of the biggest financial meltdowns of the last few decades. Everything from the long-term capital management collapse all the way up to the Great Recession.
It's really a study in how these mechanical objective systems perform under the ultimate stress test. And the sources we've looked at, they really challenge that conventional wisdom that markets are efficient or that, low volatility automatically means safety.
Right.
The core conflict we have to resolve for you, the listener, is this. Volatility isn't the devil. It's actually the engine of profit. If you can't handle the massive swings, you absolutely cannot capture the massive trends that matter most during a crisis.
We're really moving beyond that emotional sort of discretionary world of buy and hope.
Yeah, buy and pray.
And into a more mathematical, systematic world where winning is measured by consistency and control, no matter what the market is doing outside.
So let's start with that cornerstone of the whole philosophy, this concept of absolute returns. For a typical investor, success is, like we said, beating the S&P 500. But what does absolute return actually mean in this context, and why is it so critical?
It's a fundamental shift in mindset. Absolute returns means you are trying to generate a positive return, period. Doesn't matter what the market direction is. Your only benchmark is a plus sign.
So you're not graded on a curve.
Not at all.
Yeah.
And it isn't just about making money in a simplistic sense. It's about being totally unconstrained in how you do it. Yeah. That requires a huge amount of flexibility, the ability to go long, the ability to go short.
And to trade everything, right? Not just stocks.
Everything. Futures, commodities, currencies, fixed income, across the globe, without any structural bias telling you that you should be long equities.
That flexibility really seems to be the key differentiator. So if the market's going up, great, you can be long equities. But if a currency is collapsing somewhere, you can be short that currency and profit from the fall.
Precisely. And you see firms like Campbell and Company that really embody this. Their whole philosophy is centered on producing these absolute returns consistently. They even state very explicitly that they are not trying to figure out the intrinsic value of what they're trading.
They don't care if a stock is cheap or expensive.
They don't. They're focused purely on market dynamics, on price action. It's such a sharp contrast to fundamental investors who are, structurally limited because they either can't or won't go short.
And Dunn Capital is another one you see mentioned as a pioneer.
Oh, absolutely. They stand out because they've managed to consistently compound these absolute returns for decades. They survived and thrived in these incredibly volatile periods that just took out so many of their competitors who were stuck thinking about short-term relative benchmarks.
This objective leads us right into that central debate about risk, because if you talk to almost any investor, retail or institutional, they treat volatility, the speed and size of price moves, as this inherently negative thing, like a pollutant in the system.
And that perception is, frankly, a profound strategic weakness. Volatility, which is just the movement of price, is what creates opportunity. It's that simple. If there's no volatility, there's no profit, because prices are just static.
Right, nothing's happening.
A systematic trader is looking for that movement that lets them buy low and sell high. Or, more often than not, sell high and buy low. The second prices stop moving, the game is over. Volatility is the fuel. It's the fuel for the trend-following engine.
But that must mean we have to be a bit more nuanced about how we measure risk, doesn't it? Because traditional finance leans so heavily on total volatility, on standard deviation, which just measures any deviation from the average. It doesn't care if the move is up, which is good, or down, which is bad.
Absolutely. Total volatility doesn't distinguish between a move you want and a move you don't.
Yeah.
And that's why some of the research from people like Nicola Meaden is so important in this space.
What does she advocate for?
She's a big proponent of using what's called semi-standard deviation. And all that means is you only measure the downside volatility. For a trend follower, a huge upward swing is fantastic. You shouldn't be penalized for that in your risk measurement.
So you're only counting the bad volatility.
Exactly. By focusing only on the semi-standard deviation, managers get a much, much clearer picture of their actual risk profile, the magnitude of their potential loss, without being mathematically punished for successful high volatility moves that go in their favor.
And the paradox here, which is so interesting, is that this high total volatility is the very thing that makes trend following such a powerful diversifier. If a strategy had low volatility, it would probably just be moving slowly in lockstep with bonds or stocks.
That is the core realization. The willingness to accept high total volatility is what gives these strategies their massive power to diversify, especially during a crisis. They can make money when traditional assets are crashing, and that's primarily because of their ability to take short positions objectively and aggressively.
Without emotion.
Zero emotion. If they were forced to only bet on things going up, they would lose all their utility as a crisis hedge. The system dictates the position, and there's just no emotional resistance to betting against what everyone else is doing.
Okay, so let's confront the big psychological and mathematical reality that even the best systems have to face, the inevitable drawdown. David Harding said that managers are obliged to wear their worst historical drawdown like a scarlet letter for the rest of their lives. That's a powerful metaphor.
It is, because the drawdown, which is just the percentage loss from an equity peak, is the ultimate inescapable stress test. It measures the potential magnitude of loss, and that one number defines how your clients see you, and it defines their own pain tolerance. It's the number they will always, always remember.
So let's put this in context. Let's look at the history of two real titans of finance. Dunn Capital, the trend-following pioneer, and Warren Buffett's Berkshire Hathaway. We're always told systematic trading is riskier, but the data tells a kind of different story about how universal big losses are.
It really does. So over 4 decades of trading, Dunn Capital had 8 serious losses that went past 25%. That includes a really painful 40% loss between 1999 and 2000. But, and this is critical, it recovered in just 3 months.
3 months from a 40% hole, that's incredible.
It's stunning. They also had a 52% loss way back in 1976. But now, let's look at Berkshire Hathaway since 1980. Buffett's firm has weathered multiple massive drawdowns. I'm talking negative 51%, negative 49%, and 2 separate times it hit negative 37%.
That comparison is so important because it just shows that huge drawdowns are simply a universal cost of doing business if you're chasing exceptional returns. It doesn't matter if you're a value investor or systematic trader.
And the math behind recovering from those drawdowns is what dictates everything. This is where the drawdown recovery chart becomes, I think, the most terrifying piece of math in all of finance. It really highlights the emotional toll.
Yeah, break that down for us.
So if you have a 25% drawdown, you need a 33.3% gain just to get back to where you started. It's tough, but it's manageable.
But the curve gets steep really fast.
It gets brutal. If you suffer a 50% drawdown, you need a full 100% return just to break even, a 100% return. And if you're unlucky enough to lose 80%, which so many .com investors did, you need a 400% return just to get your starting capital back.
Wow.
That realization that recovery is nonlinear and just mathematically devastating is why the mantra of cut your losses early is the single most important rule in trading. If you let a 10% loss turn into a 50% loss because of ego or because you're frozen, you've basically doubled the difficulty of getting back to your peak.
But our sources do note an interesting flip side to this fear. Some of the more sophisticated clients, the institutional ones, they actually view these drawdowns differently.
That's right. They see it as a buying opportunity. If they've done their homework and they have real conviction in a manager's systematic ability to recover quickly, like Dunn did with that 3-month rebound, then a 30% drawdown is just a chance to buy in on sale.
So they're buying when everyone else is panicking.
Exactly. It completely transforms that feeling of fear into one of tactical opportunity. But that requires a really deep understanding of the whole process.
Okay, so let's shift from the individual manager to the broader portfolio context. Because for you, the listener, trying to build a robust portfolio, diversification is everything. And diversification really hinges on one thing: correlation.
Yeah, correlation is just the statistical measure of how two investments move relative to each other. A perfect correlation is +1, meaning they always move together. That gives you zero diversification.
You might as well own just one of them.
Right. You're looking for assets that are close to zero correlation, meaning they're independent, or, in a perfect world, mega 1. That means when one zigs, the other one zags.
And the data on trend following's correlation to traditional assets, I mean, it's arguably its most compelling feature.
It's that free lunch of diversification in action. Trend following has consistently shown a low, often near zero, correlation to things like the S&P 500 and bonds. Campbell & Company's performance analysis, for example, showed this incredibly low correlation to the S&P, and it held up over decades and across multiple rolling time windows.
It makes it the ultimate teammate in a portfolio.
That's the perfect way to put it. It tends to make money precisely when everything else is falling apart, providing this necessary ballast when you need it most.
Now, we have to talk about where those profits actually come from, because this brings up that zero-sum dynamic. If trend followers are making huge profits when the stock market is crashing, well, somebody else is on the other side of that trade, taking the losses. And that can feed this perception of the market as being predatory.
This is where that guilt mindset among losing traders, this idea that for me to win, someone else has to maliciously lose, is, as our sources put it, just poorly thought out. The reality is purely mechanical.
So it's not personal.
Not at all. As the researcher Harris notes, winners profit because they have these persistent, systematic advantages that let them win slightly more often or, and this is the key, occasionally much bigger than the competition.
It's not malice. It's just better execution and better risk management. John W. Henry, the trend follower and now sports team owner, he articulated this advantage perfectly.
He did. He explained that trend followers win the losses of the market losers because they rely on a fundamental flaw in human behavior. The fact that other traders are convinced they can predict the future. They're trying to forecast what's going to happen next week, next month, next year, and they are inevitably wrong when the big trends shift.
So the systematic trader is essentially just exploiting the cognitive biases of the discretionary traders, people who get anchored to old valuations or who fall prey to confirmation bias.
Absolutely. The trend follower doesn't need to predict. They just have to wait for a trend to actually start, follow it with disciplined risk sizing, and then exploit the lag time it takes for those emotional, forecast-driven traders to finally admit they're wrong. That lag, that's where the profit is made in the zero-sum game.
Let's examine this mindset by looking at some investment icons who really embodied these principles, even if they weren't all strictly systematic managers. And we have to start with George Soros and his legendary bet against the British pound in 1992.
Oh, that trade. It's a textbook example. It netted him at least $1 billion, and it was a quantitative approach applied with discretion. Soros was always looking for opportunities where the upside was just massive and the downside was limited and known.
And the British pound was a perfect setup.
It was clearly overvalued within the European exchange rate mechanism at the time, and he just had the conviction to risk a huge amount of capital on the short side.
His insight was structural, but his risk management was pure quantitative discipline. He was willing to risk his accumulated profits way more aggressively than his original starting capital.
And that is such a profound point. Once he had a profit on the trade, he saw that profit as essentially house money. It was expansion capital to be deployed to press the winning bet, not capital to be hoarded and protected.
So if he was wrong, he'd get out quick.
Cut it instantly to protect the base capital. But if he was right, he had the conviction and the position sizing to stay with that massive move until the Bank of England was effectively forced to surrender. It's the ultimate example of that core principle. Cut your losses short and let your profits run.
Okay, let's flip the coin and look at Warren Buffett. He famously preaches fundamental long-term value investing. If he's already the gold standard, why would combining his firm's shares, Berkshire Hathaway, with a systematic trend fund provide such a dramatic benefit?
This specific bit of research is one of the most compelling arguments for diversification I've ever seen. Researchers looked at what happened when you combined Berkshire Hathaway shares with a systematic trend-following fund managed by a firm called Drury.
And the result was pretty significant.
It was genuinely remarkable.
Yeah.
Adding the trend fund reduced the length of the most painful drawdown you would have experienced holding Berkshire alone by 43 months.
43 months. That's almost 4 years. So a client holding just Berkshire went through a brutal 61-month period. That's over 5 years of being underwater. And by adding a trend component, you could have cut that pain down to just 18 months. That's a life-changing amount of time for an investor.
It absolutely is. And it just validates that old quip that diversification is the only free lunch in finance. Even the best long-only investor in the world can't escape these long, painful downturns. The trend follower, with their ability to go short and trade other assets, acts as a hedge that makes money at the exact time the long-only portfolio is suffering its greatest pain. It just smooths out the whole ride.
This brings us right to the ultimate proof of concept. How do these objective systematic strategies perform when the market goes from normal volatility to just full-blown panic? We're looking for proof that these systems actually thrive in the chaos of a financial crisis.
This is where theory hits reality. And yeah, the results are incredibly consistent. Let's start with the biggest crisis of our era, the systemic failure of the Great Recession between 2007 and 2009.
During that period, the traditional leveraged, long-only buy-and-hold approaches, the ones based on efficient markets and low volatility, they just cratered. They were structurally incapable of handling a meltdown that hit everything at once.
Everything. Stocks, real estate, even some bonds. Contrast that with trend-following managers who made enormous profits in 2008 when almost everyone else was getting wiped out. The systems profited by identifying and riding these massive persistent trends that grew out of the chaos.
What are some of those trends?
Huge short positions in the US dollar, for one. Significant long positions in safe haven assets like gold, and also in energy markets where you had these big price dislocations. And crucially, because volatility was so historic in some markets, the systems would automatically reduce or even eliminate risk exposure in those areas just to conserve capital while they pressed the winning trades.
We have a specific technical example here that really shows how the system can see trouble brewing long before the consensus does, the long December 2008 Euribor trade. We need to unpack what that signal actually meant.
Yes. This is a fantastic technical nugget. So Euribor stands for the Euro Intrabank Offered Rate. It's basically the rate at which European banks lend money to each other.
Oh.
The trade was in Euribor futures contracts, which are tied to expectations of future interest rates. A long position in a December 2008 Euribor future was a bet that future interest rates were going to fall.
And why was that a warning sign for the stock market?
Because falling interbank interest rates are a huge signal that central banks are anticipating economic distress and are trying to pump liquidity into the system. The system placed this long Euribor position, effectively a bet on economic pain and falling rates, well before the global equity market crashed in the autumn of 2008.
So the system doesn't predict the crisis?
No, it just follows the price signals in these more obscure markets, like fixed income futures. They act like canaries in the coal mine. They react to the deteriorating credit conditions way before the pain shows up in the headline stock indexes.
Let's rewind almost a decade earlier to the dot-com bubble bear market from 1999 to 2002, another period of just spectacular one-way trends.
It was a perfect environment for this kind of trading. The returns cited for trend followers during that bear market were just staggering. Bill Dunn posted a return of plus 54.23% in 2002. John W. Henry was up 45.06%.
Wow.
The collapse of that technology bubble generated the intense, persistent trends, both the huge run-up in the late 90s and then the long, dramatic fall, that these systems are explicitly designed to capture.
And that era also gave us the ultimate case study in the danger of conviction without an exit plan. The Enron fiasco.
Oh, Enron is the poster child for the behavioral failures of long-only investing. Investors just clung desperately to that hold-on-forever mantra. They were convinced the stock represented unstoppable growth and real value. They had absolutely no systematic strategy to sell.
So when the fraud unraveled and the trend completely reversed?
They were just paralyzed by denial and by ego. The disaster is just the typical story of, frankly, inept individuals managing wealth with no mechanism or discipline to cut their losses when the time comes.
But the greatest cautionary tale of theoretical hubris in modern finance has to be the 1998 long-term capital management collapse, LTCM. This story is so important because it explains the mathematical flaw at the heart of so much of academic finance.
LTCM was a true monument to intellectual overconfidence.
Right.
It was founded by Nobel Prize winners Robert Merton and Myron Scholes. They used these incredibly complex mathematical arbitrage models. And their fatal flaw was this naive assumption that the market operated as a tidy, perfect, normal distribution.
The classic bell curve.
Exactly. For our listeners, assuming a normal distribution means you assume that massive outliers, what we call fat tails in statistics, are virtually impossible.
Right.
In a normal distribution, an event like a 6 standard deviation move, which is a dramatic, rapid market crash, is deemed so mathematically improbable it should happen less than once in the lifetime of the entire universe. LTCM's models were built on this academic view. They effectively believed extreme volatility just wouldn't happen.
But the real world, as we see over and over, is defined by those fat tails.
It's where everything important happens. The moment those large outliers occurred, LTCM's entire model just broke. Their strategy was convergence, betting that two different but historically linked assets would eventually come back to their theoretical average price.
And they used a ton of leverage to do it.
Staggering leverage. They grew to over $100 billion in borrowed assets and had over $1 trillion in market exposure. When the Russian debt default hit in August 1998, it wasn't a contained event. It set off massive global contagion. And instead of assets converging back to the mean, they diverged violently.
And their risk management.
It was, as the sources say, devoid of anything remotely resembling trend-following risk management. They had no system to cut their losses when their beautiful theories were clearly failing. They just doubled down, believing the models had to be right until the leverage completely wiped them out.
And it required that massive Federal Reserve bailout to stop the whole financial system from collapsing. What was the trend followers' view on that crash?
Well, John W. Henry noted that the actual market trends that crushed LTCM had been in place for weeks, even months beforehand. The only real surprise was just the sheer magnitude of the price moves, not the direction. The trends were signaling divergence, and the trend followers were positioned for it, while LTCM was betting on the opposite.
And Bill Dunn was pretty blunt about the bailout.
Oh, he was emphatic. He flatly called the LTCM bailout improper, arguing that a failure on that scale should have been allowed to collapse as a lesson for the market.
Let's trace this systematic strength through some of the other huge contagion events that even came before LTCM. We see this recurring theme. Chaos creates opportunity for the disciplined.
It's the same pattern over and over. The Asian contagion of 1997-1998 was a massive system-shaping event. Currencies just collapsed across Southeast Asia, which generated these huge, persistent trends. John W. Henry confirmed that this period offered enormous opportunity, and it led to massive zero-sum wins for trend followers who were shorting those collapsing currencies and equities.
And the collapses of Barings Bank in '95 and the German trading house Metal-Gesellschaft MG in '93, they both hinged on the exact same behavioral error that killed Enron, just refusing to take a loss.
Absolutely. They didn't have systems to force them to admit they were wrong. In the MG case, they were holding these massive long positions in crude oil futures that were just hemorrhaging money. Their strategy was just to hold on, hope the price would come back.
And the trend followers saw blood in the water.
They acted like zero-sum predators. They saw a clear, persistent downtrend and a huge player trying to fight it. So they aggressively shorted crude oil, reinvesting their profits to make their short positions even bigger as the price fell. It just demonstrates that ruthless reality. Disciplined systems will inevitably profit from the panicked, emotional refusal of others to cut their losses.
And Barings Bank.
That was more a failure of oversight, a total breakdown of internal controls. But at its heart, it was the same story. A massive accumulation of loss by doubling down on bad bets, hoping for a reversal. Henry confirmed he had a substantial win during the Barings collapse, though he kept the details pretty cryptic.
Finally, let's go back to one of the earliest modern crises, Black Monday in 1987. Trend followers did great, but the reaction they got is really instructive about the skepticism they always seem to face.
It is. Larry Hite, a very successful trend follower, was called a 1987 fad after his success during the crash was confirmed. It just highlights this constant skepticism. Even when they're validated by a crisis, when everyone else is losing their shirt and they're making money, they're often dismissed as just being lucky or being in the right place at the right time. The criticism never really changes, even as the strategy keeps proving itself decade after decade.
So if we synthesize everything we've covered, from the brutal math of drawdowns to the structural failure of LTCM's models, what is the central, unavoidable takeaway for you, the learner?
The central takeaway is that no matter the crisis.com LTCM, the Great Recession systematic trend following, was able to adapt and profit because its systems are built to expect the unexpected. They expect nonlinearity. They expect fat tails.
They're built for a world that isn't neat and tidy.
Exactly. The strategy's longevity and its consistent performance in crises just confirms that markets are not rational. And the only reliable edge is a consistent mechanical process that removes human ego and prediction from the entire equation.
The efficiency of the market is completely irrelevant to this approach. The system doesn't need the market to be rational, it just needs the market to move.
And that brings us right back to John W. Henry's core philosophy, which just perfectly sums up their competitive advantage. Henry said, "We rely on the fact that other investors are convinced that they can predict the future, and I believe that's where our profits come from." The trend follower profits from the predictive ambition and the resulting behavioral flaws of everybody else.
The very fact the trends persist, the phenomenon that they exploit, proves that markets are driven by emotion, by cognitive biases, by social pressure, not by detached objective rationality. If the market were truly efficient, there wouldn't be any trends to follow in the first place.
And the lesson here really goes beyond just trading mechanics. The entire history of crashes and drawdowns just confirms that these big, unexpected events happen far, far more often than the naive, tidy models like the ones that killed LTCM ever predict. The real market is non-normal.
And that leads us to our final provocative thought for you, the learner. The challenge isn't just to intellectually accept that these events happen. It's to internalize that the real world is non-normal and that it requires a consistent mechanical process to navigate it. If you can't accept that uncertainty, you're doomed to repeat the same high-leverage, no-exit mistakes that destroyed Barings, that destroyed MG and LTCM.
So we'll leave you with this question. What foundational assumptions about stability are you holding on to right now in your own financial life? Are you relying on a tidy academic view of risk? And if those assumptions turn out to be wrong, what is the mathematical cost when the inevitable black swan finally lands? Think about the recovery math. Think about what it takes to dig out of a 50% loss. That is the true measure of risk you have to confront.
Until next time, keep diving deep. And remember the mantra: honor the scarlet letter, cut your losses, and let your profits run.